Welcome to the daily update, where I'll go over the action in the market for Monday, November 10th, and we'll see how things look for Tuesday, November 11th. Well, the nice little rebound that we saw on Friday, where we hit the low and then made an impressive recovery to close a little bit positive on Friday, that continued on Monday. Now, there's a lot of optimism right now. There's a possible end to the government shutdown. It isn't official, at least at the time I record this. And so the market seemed to like that. The futures were strong. A lot of the gain that we saw in Monday's session came from the gap. Now we held on to the gains and we built on those, but the big move was from the Friday to Monday gap higher open. We are improving, but we're still negative. Now, the only thing that's turned back over to positive, which is a big thing, is we've recaptured the 20 period moving averages. So we're back to looking positive in the short, intermediate, and long term that way. And we're seeing improvements with some of our indicators that are based on the S&P 500, but they haven't turned positive. And we're seeing some of the internal indicators that we look at that are improving, but have not turned positive, at least yet. All right, I just want to send out a very heartfelt thank you to any of you listening to this. Either you're part of a family, or you served directly, or you served in any capacity at all. We enjoy the freedoms, at least for a little while longer, that you helped to defend and to protect. And so thank you. And the bond market will be closed on Tuesday for Veterans Day, but the stock market will still be open, so it'll be a little lopsided there. But my grandfather served in World War One. My father served in World War Two. I have folks in my family that have spent a career serving and a lot of friends. And so thank you to all of you. Okay, another thing to be aware of is I have a program called the SPX Investing Program, where you get immediate access to this video and all the videos that I produce. There are additional videos that I post there. Feel free to check that out. Here's the link up above. It's also below this video. You can click that and check it out. It's free until the end of 2025. Now, let's go in and talk about the market here. At the open, we had a gap higher open right at R2, right around that level. We started below it and then quickly went above it at 67.95. Then we did keep going. We got above 6,800 and then we declined back below R2, but it was just a normal little pullback. It wasn't a real shift. I was watching this as it was unfolding to see, okay, are we going to switch over and go more negative? Because we always have to be a little concerned about the pump and dump things that can happen where we have a really positive open and then selling starts to come in and then it just builds on itself. And before you know it, we're more on the defense than on the offense. Then we did rebound back above R2. Then we just held on to the gains. Didn't see a lot of late day selling. We climbed to close near the intraday high, slightly above the 68.30 level. R3 was still well above current price, so we didn't get close to that. And we were up 1.54%. Now, this is a warning sign here. We were below average with volume. We have to be a little bit concerned about that. Now, it is kind of a pseudo holiday. I mean, it's a full holiday for Veterans Day, but as far as the markets are concerned, part of the markets are closed, part of them are still open. So maybe a 4-day weekend for some folks here, just taking an extra day off with Tuesday being a holiday. But at the same time, when we see a nice upward move and a decrease in volume, where typically we've been above average with volume, it's just a concern there. And as I said, we're positive again in the short, intermediate, and long term based on moving averages. Interest rates are kind of helping things right now. Last week, we were a little bit concerned that we were seeing more of a flight to safety with money coming out of the stock market and going into the bond market. Didn't seem to really happen in Monday's session. And even though there's no real definite deal and there wasn't a lot of news on Monday, the market just it liked what it experienced last Friday with that reversal that we saw and then just kept going in Monday's session. So, some comments. The Senate passed a procedural vote on Sunday to end the government shutdown. Senate Majority Leader John Thune hopes for a final Senate vote. See, it's not in the bag yet, on the government funding deal that they're trying to get through in the very near future. Now, okay, when a politician says very near future, that could be decades, but no, the hope is there. Once the air traffic controllers started to get laid off or not coming in, that's affecting people more directly. I mean, it's one thing to close national parks, and it's another thing to do the different things that have been affected. And of course, there's some real nasty stories on personal levels of what folks have had to go through. But when you see it on a bigger scale, and it really seemed to, and of course, the election that played into it too. There was, this is a political game that goes on here where maybe if we keep the government shut down through the election that was last week, that will help the election do better. And maybe that goal was achieved. And so now that that has passed and air traffic controllers were staying, they were telling them, don't come in and we're going to have to cancel a bunch of flights. That's more direct. So there's still some procedural hurdles to overcome, though. And of course, procedural hurdles, that's called politics. So there'll be some back and forth and maneuvering that goes on there. And so we did see follow through strength with the mega caps and growth. Growth had a really strong day there. We still have some bigger picture concerns, and I'll show you those charts later on. We improved, but we haven't switched over to looking more offensive, at least yet. And we did get back above the 20 period, both simple and exponential moving averages. We still have another spike. Now, there's a 1 day lag, and this is from Friday, the spike that we're seeing now. And we're seeing a series of spikes. The more spikes we see, the more concerned we should be with this Hindenburg Omen. We'll see what happens after Tuesday's session when the chart is updated again, if there's another spike there. And we just have the CCI 14. Now that's looking, it's improving a little bit here, but it's gone back up to more the middle. But pretty much everything else is now off of the list. No change to the overall Fed scenario. And the dollar was up. We want to keep an eye on that. If it gets above the 100 level and starts to get into an uptrend, that might be a problem for stocks. And interest rates were also up, not very much. We closed at 4.11% with the 10-year yield, where after Friday we were at 4.09%. We're improving as far as sentiment. We got all the way down to 21. And it's like, okay, that's not very good. It's below that 25 level, which is when we start thinking of this as a contrarian indicator. We've worked some of that off. We're still negative, but we climbed all the way back up to 32. So that did improve there. We're still not trending though. And the ADX charts, both in the short and intermediate term, they were picking up a negative trend that was starting. Well, then we have this update on Monday, and that throws the ADX back down, and we're not coming above the moving averages in the short and intermediate term. The red line's coming down, the green line's going up, but we're still negative overall. That hasn't switched over to positive, and the bias is positive. The momentum, I could have changed that over to mixed. In fact, I probably should have with that one. Okay, so we did not get any economic reports here, but I forgot to update that slide. There were none scheduled, and now we'll see what starts to trickle out. I mean, we're going to get reports and revisions of reports, and the market has to figure out all this stuff and try to put all these stories together, and that could be a bit of a mess once we start getting. We have two employment reports. Now, we did get CPI a week ago or a month ago, but we didn't get PPI. We didn't get retail sales. Those are supposed to be coming out. And so what's going to happen with all of that? Well, the market's going to have to digest all of this and decide, okay, are we looking more positive or are we looking more negative? All right, so here we go. The longest shutdown is finally over. I wouldn't say that. There hasn't been a final vote yet. This just goes through the different times in history when we had government shutdowns and how long they lasted. And the media really likes this is the longest government shutdown in history. Okay, fine. It really was kind of for most folks on a bigger picture level, unless you were directly infected, it really wasn't that big of a deal there for quite a while. It just kind of became a big deal later on, and then that's when something was potentially finally being done about that. Okay, and then looking here that we're still above zero when we look at equity positioning. Folks that are positioned in stocks It's coming down a little bit here, but it's still above zero overall. So they're leaning more towards the stock side. And this, I don't like this chart here because they're trying to use an apples to oranges comparison here. The Russell 2000, that's calculated differently for the small caps. That's why I also look at the S&P 600. Now, if you're looking at the S&P 600, we're more over on the right-hand side where we're fairly priced. But then you take this Apple's Russell 2000 small cap index to oranges PE calculation, and you come up with this massive. To me, it's misleading in that regard. Coming in at 24, where okay, the Nasdaq 100, we'll take that. That's yeah, we're up around 29. We're well above that 20 level. But this is the same as what we've been seeing now for quite a while, with the S&P above 20 at 23, where the equal weight and mid caps, and then I would include the S&P 600 small caps, they're more in the fairly priced area. And then the discretionary versus systematic types, where systematic just means you follow a system, you don't really follow the market maybe as much. You're just, okay, I'm always long here. And they tend to do better when the market's going up. Well, we've been under pressure lately, so that's been coming down. Where the folks that, okay, now I'm going to try to pick better times to get in and get out of the market, they're still below the zero level here and haven't been performing quite as well. If we hit more of a sustained downtrend, then that's when we'll see this green line go above the blue line. But when the market's really solid and going up and setting all-time highs, then the dark blue line tends to be above the green line. And we haven't seen a real shift in that, at least yet. Then this is a long-term trend channel. Okay, going back to 2022, I have other trends that we look at here. It just says it's now back at the bottom end of the trend channel that's gone over the last 3 years here. Okay, I'm not sure quite what to make of this because, again, you could draw whatever lines you want on the chart to tell whatever story you want to tell. I don't know if this chart is all that helpful, but we've been kind of at the end. We could be getting some support off of this because this breaks the rules of drawing trend lines. We have a low here, but then why are we connected to that low? Why did we go through this low? And then we have the big downturn in April here. And then why is this line where it's at? It could easily have been drawn in a different place. The top one, even that, it's not really connecting the highs. It's like we have a chart here. Now let's fit the lines to say what we want it to say. At least that's my approach with this particular chart. You might disagree with that. Okay, then unlike CAPE, which is the Robert Shiller way, I go over that in the intermarket analysis video over the weekend. Our U.S. real value index indicates only modest overvaluation. Now, if you stick to static numbers, the 10, 15, 20 scale, like we do with the PE ratio, we're overvalued. But if you use more dynamic things that change with the market over time and lines that move instead of always staying in the one place, then yeah, we're probably not as overvalued. The big takeaway that I get from this is what are earnings looking like going forward? And they're still looking positive, and that justifies stock prices going up. And we see this, this is like the fourth or fifth time we've seen this actual chart put out by Goldman Sachs, where they're still projecting 12 months from now we'll be at 7,200 with the S&P. This is the earnings forecast going forward, which is also going up, is what I just alluded to. And then we're seeing a lot of money coming out of crypto right now. You know, there's all these theories and stuff out there, and this is not a market that I pay as much attention to as I do the stock market and the S&P 500, but we are seeing a lot of money coming out of those assets right now. And then equity fund flows, still seeing it's pretty strong. Now this is more global. It's attracting 39 billion last week from the US and China. Tech funds, that's where most of the money is still going. This is pretty much a continuation of what we've been seeing all along. And then here is the chart where you can see the gap. Now, here's that impressive bounce that we saw back on Friday. We were coming down. It was looking pretty ugly at that time. And if you watched any of the weekend videos, I addressed that. And this was impressive, how we came back up. We actually ended up closing positive on the day. The futures were strong when they opened Sunday evening, and that they were up about 3/4 to a percent or so. And then we did build on that. We saw a little bit of weakness here falling under R2, but then instead of switching over and turning more negative, we started to go back up, back above R2. R3 was like way up here. It wouldn't even be on the chart. And we held on to the gains and closed just a little bit above, or excuse me, a little bit below the intraday high that we saw there. And so here is the big spike up that we saw. So if you look here starting Sunday evening, okay, we held on to the gains, we saw some strength, and then we actually dipped down here after the market opened. But then we were able to get that back and hold on to those gains and not seeing much of a change in the initial overnight session for Tuesday. We are improving here with our intraday growth to value charts here. The red line and the blue line, they're both going up, so that is positive. We're coming, excuse me here. We're trying to come back up to these previous highs here. We're still looking okay in the bigger picture. If you go back to the beginning of September when this really started to go up, we saw some weakness here halfway through October, came back up. We have been coming down. Now, we want to be able to break above this series of lower highs right here and see this continue to go up, or we're in danger of going back down and being range bound. This is also improving. We're back above the moving averages with the intraday growth to value ratio for the S&P, but we still have a ways to go to get back to these previous highs. So end of day growth was up monster here, 2.31%. Value was up 0.68%. So growth really outperformed for the large caps, also outperformed for the mid caps and underperformed with the small caps. So still looking okay here, but we really haven't broken out with the small cap growth to value end of day chart. And we were seeing some weakness coming into the mid cap growth to value ratio here, but we're turning back up above the 200-day moving average. And we're back above the 200-day moving average here with S&P growth to value. So we're improving, but we are still well below this 50-period moving average. We need to see this continue to go up, and it's possibly the start of something here, but we want to see more follow through with this. And we're coming back out into the top end of the rainbow with this growth to value ratio. Not all that much of an improvement, still below the 50-day moving average with discretionary to staples with that ratio. And we're still negative. See, the ADX was starting to come up and we were starting to see a new trend in the short term. And the red line was above the green line. So it was picking up a negative trend. Well, with the update, now the ADX has dropped down below the moving average. And even though the red line came down and the green line went up, the red line's still on top. So we still default to negative there in the short term. And also with the long term, or excuse me, intermediate term, we did come down with the red line. The green line is going up, but instead of coming up above the moving average, and it almost got there, now it's starting to go back down. So we're still in a non-trending environment in the intermediate term. We did drop off with volume, and we've seen a general dropping off here, but we've been above average, except for the big up day on Monday. Then we dropped to below average with volume. And then we look at this every week. This is more of a composite. We're still coming in pretty hot here at 70.36. It's still positive. I wouldn't put greed there. I would put positive there and then extreme positive. Where the reading that we're getting on the daily charts are we've been extreme negative and now we're starting to be improving up to just negative. This also shows a bit of a drop down here with the Goldman Sachs sentiment indicator. It barely went positive there for a while, and now it's starting to come back down again. And then the euphoria meter, this is also longer term here. It's still having a tendency to go up overall. So sentiment is still looking okay in the bigger picture. And even the market's looking good in the bigger picture. It's the shorter term that we've been having some issues with here. And we're back to green again with our gamma exposure. Now we're not quite up where we see the column here up to the blue line at 6,900. Now, if we keep going up that way, these will probably intersect with each other. And round numbers tend to be resistance when we're below and support when we're above. And we did see a move back above the 6,800 level here. So where we were looking at a lot of red after Thursday and Friday last week, now we're seeing more green coming back in. So the gamma exposure is tilting back more to the positive side. And not much of a change here. These are legal insider transactions, pretty much at the neutral point now. And then here's the insider buying ETF. A lot of folks, this is how they do things. They want to know What are the insiders doing? The corporate officers, the CEOs, the people that are really in the know about a company. It's been taking a bit of a hit, but it bounced up in Monday's session. We're still slightly above the moving average with the Ulcer Index. That's still picking up some fear. And we're still below 20 now on a closing basis with the VIX. We climbed above 20 on Friday, only to close back down below 20, and we are declining with the VIX overall as we had a fairly good update. Not really hanging here with the seasonality of what the VIX typically does during this time of year. We did see a drop off here with the VIX of the VIX. So the volatility of the VIX is starting to slow down itself, dropping below the moving averages with the bar chart and the line chart. And we came down with this fear gauge and we came down with this other fear gauge. So some fear came out of the market on Monday and we saw a drop off in the daily equity put call ratio chart. And we're coming down with the 5 day chart, but we're still going up with the 10-day chart. It's longer, so it's going to take a little bit longer for this to roll over after becoming quite extremely low here. That's quite often what marks tops in the market. And we did improve with the risk on to risk off ratio, but we're not breaking out to new highs. And the high beta to low beta ratio, we improved there, but we're not back to previous all-time highs. We are seeing a bit of a pickup, but we're just at the upper end of the band here when we look at volatility risk premium. We want to keep an eye on this. We had a really high reading here in the latter part of July, and then we had a pretty significant downward move once we got into August. It was also picking up some real fear coming into the market in October, and then we had that big down day in October. So we wanted to watch this. If this starts giving us a high reading, and we're not necessarily seeing it in the VIX and some of the other sentiment gauges, we want to pay attention to this. All right, and we did improve, but we're not back to highs yet with the advanced decline line based on price and volume. We're above the midpoint with the short and intermediate term advanced decline ratio, and we actually ticked down a little bit with the advanced decline oscillator, and we're still below zero. That's still negative, and we're still going down with our 5 day and 10-day chart, even though we saw a bit of an expansion of the new highs, a bit of a contraction of the new lows, but not enough yet to turn the moving averages back up. We're positive now with all three smart money indicators. So there was some strength in there. We came back above the moving average with the longer term accumulation distribution, and we're back above the moving average with the boom indicator. We're positive, and we did turn back to positive after Friday. We're seeing that continuing to be positive after Monday. And the same thing here. This turned up after Friday. It's continuing to go up after Monday with the Chaikin oscillator. We're still negative with the vortex. The red line is still above the green line. And we're improving with the advanced decline line here, but the only index above its moving average is the S&P. We're still seeing the NYSE mid caps and small caps below their moving averages. And this is continuing to decline. I pointed this out over the weekend, but this is slower, so it's going to take a while for this to improve if that's what it ends up doing. This is a 10-day average of the highs and lows for the S&P, and this is continuing to go down. The context is that we're negative because it's declining. It'll turn officially negative if we drop below the 50 level. And we improved, but we're still below the 50 level here with those stocks above their 20 period moving average, 50 period moving average. We're actually turning a little bit more positive again above 50 with the 100 period moving average study. We so far haven't dropped below the 50 level with the 200 period moving average study, and that improved slightly. So in the short term, we did recapture the 50 period moving average on Friday, and then we have a gap now again, and we started off right at this pivot point, and this looks pretty healthy, at least for right now, but we need to see more follow through with this. On the bottom, we were below average with volume. So we did improve with the 20, 50, and 200 period moving averages on the S&P. After being extreme negative, we are coming back up, but we're still below the midpoint with the Stochk RSI. We're back above the midpoint with the Williams percent R, coming back above the midpoint with the CCI 14. I had that as extreme negative. Actually, we're more neutral right now, and we're above the midpoint with the CCI 20. Nothing really extreme right now with the short, intermediate, or long-term subdivision of the short-term time frame with our stochastics charts, but they're trying to turn back up. And we're positive again and above the midpoint with the force index. We did get back up above the 20 and 30 period moving averages. We're still the green line here. That's the 10 period moving average, and we still haven't really decisively climbed above that yet. And we're improving here. We were seeing some vulnerability to the short-term trend based on 20 periods since we spent a number of days below these lines and the lines were going down. Well, now we're back up and slightly above the line. So that's an improvement there. And we're back above the 20 period simple and exponential moving averages. So that's turned this back to positive. We're up into the +1 channel with the standard deviations chart. We're improving, but still below zero with the balance of power. We're turning positive with the go, no go with the darker blue bars. We're above the midpoint with the highest high, lowest low value chart. And we don't know what's happening here. Landry Light needs to think about things for a little bit here. It came back down to zero after Thursday last week and then stayed that way after Friday. It still hasn't really picked up anything yet. That's my problem with these kinds of charts. It has to think about things for a few days, and then it'll come back and say, "Oh yeah, well we would have started an uptrend a couple of days ago." Well, we need real time stuff, not things that go back and recalculate, which is another reason I don't use Elliott Wave. And this one is after taking a couple of days off with the proper order, we're still seeing an uptrend here. We're on day 12 there. But we're still negative with the TTM squeeze. It's darker blue and actually declining. And we're just a little bit above the moving average here with standard deviation. This is over the last 10 periods. This just shows that we've been moving rather quickly, even though we've spent a lot of time not trending. And we're just barely negative with the ease of movement. So it did improve, but not to go above zero at least yet. The Arun's taking a 4-day weekend here. And this is some improvement that we needed to see. Now we need to see more follow through. The McClellan oscillator for the S&P climbed back above zero. And when that's above zero, we're starting to turn up with the summation index based on price. We are already going up here based on volume. So that is broader and longer term, and that is improving there. We're just barely above zero again with the NYSE McClellan oscillator. Can't really see it here, but we're starting to tick up with the summation index for the NYSE based on price and volume. Now, this kind of hung in there and was looking positive even last week when we were under some pressure. But the swell and trading oscillator, we're crossing above the midpoint and advancing based on price and volume. But we're still looking more negative with our momentum oscillators. The PMO is still below the moving average. We're turning up, but below the moving average based on price and volume. So we did improve. We're slightly above 50 with the PMOs that are rising. Turning back up, but still below 50 with the buy signals. And we're still declining with the PMOs that are above zero. But we've gone from negative back over to positive now with the Elders Impulse system. We're still negative though with the parabolic SAR. We need to see more follow through for that to turn positive. And here's our momentum oscillators. The slope oscillator is still negative below its moving average. The MACD ticking up a little, but it's still negative. So in the short intermediate term, we are negative with all of our oscillators and still rolling over here and kind of flatlining, but leaning a little bit more negative with the Trix and KST, which are our two long-term oscillators. Negative with the Copic curve. That hasn't switched back to positive. We did improve with the Sean trend meter, and we're coming up into this darker green area now. So that is an improvement there. We're still above 50 with the money flow. We crossed back above 50 with the ultimate oscillator. We're still above the moving average with unbalanced volume. And we came back above 50 with the short and intermediate term RSI. So that's an improvement there. We did tick up with the bullish percent index, but we're still below the moving average. So that's still treated as negative. And we're barely back above 50 with the NYSE bullish percent index. We're still below 50 with the NASDAQ 100 bullish percent index. And coming back up to the lines here, we're kind of flatlining with the intermediate term trend based on 50 periods. We need to get above this and see these lines turn back up to be more positive. We're above all the plotted moving averages, though, so that's positive in that regard. And we're back further than 10% above the 200-day simple moving average for the S&P. And then we're coming up out of this little mini rainbow here. And see how we're kind of flat right now? We started to break through the mini rainbow. We got to the lower end of it on Friday. Now we're breaking out of the upper end of it after Monday and still looking okay here. And as I pointed out over the weekend, the bars are in the longer term. These are weekly bars. The integrity is still there. For the most part, we're seeing higher highs and higher lows. And that hasn't changed, at least yet. So looking a little more positive after we've been seeing some weakness with the Heiken Ashi chart. Now we're negative since we're red, but now we're pointing up with the Kegi chart. We're positive with the Renko chart, but we're still negative with the three-line break chart. And we did see some X's drawn in here. No signal that's being generated now with the point and figure chart. We were seeing some O's drawn in here last week. Now we're seeing some X's coming back in. And we did see a tick up here with the 150 and 200 moving average study there. Longer term showed some slight improvement. Now we're back to positive on all time frames because we recaptured some moving averages there across the different stock indexes that we look at. Still negative in the short term with bonds based on price, and we're still looking positive in the short and intermediate term with the dollar. And this is what we wanted to see on a positive day. The defensive areas, they were down. The growth areas, tech, discretionary, and communication, those were the stronger areas. But we need to see more follow through with this. We need to see these near the top for the next number of days to switch things back and make them look more positive. So an awful lot of green right off the bat. We had a BPI cross back above 50 with the NYSE. We were seeing some weakness there. Materials also had a BPI cross back above 30. They were becoming rather oversold. Canada was doing pretty good there. And we got above 6,800 with the S&P. The Dow got above 47,000. And then we kind of danced all around with the NASDAQ. First 23.3, 22.32, 23.1. Then we bounced back up to 23.4, got up to 23.5. We did see a BPI cross below 50 later in the day, and also a BPI cross back below 50 with the NYSE. So this is a little bit of a concern here. Not an awful lot of strength, and this is going more into the afternoon part of the day. But an awful lot of green. When you look at technology, I mean, you have Nvidia, Apple was up a bit, Microsoft was up okay. You had Broadcom up, Oracle was up, both Google stocks were up, Amazon, Tesla. When these stocks are green, that's when the market really goes up. And then the red areas are more of the defensive stocks. So we did get back above this pivot point with the Dow. We came right down almost to the 50 period moving average on Friday, and now we're trying to bounce back up off of that. And we've gone to positive with the diamonds, with the Elder's Impulse system, and there, we produced another gap here, and we're above this pivot point. That's about where we opened with the Nasdaq, and we're still above that level after coming down and dropping below the 50-day moving average on Friday and this S1 pivot point. So for right now, the support is holding and we're positive with the Elder's Impulse system. And we also lost the 50-day moving average, came down to this pivot point, and then gapped up with the NASDAQ 100 and still holding out above the pivot point for the NASDAQ 100 here. And we're positive with the Elder's Impulse system, but the momentum hasn't shifted over to positive yet. For the NASDAQ 100, we reclaimed the 20 period moving average here, so that's positive for the QQQs. Small caps, yeah, they had an up day, up 0.95% with the S&P 600, but we're just coming right back into the range that we've been in. We did recapture the 50-day moving average, though, with the Russell 2000 small caps after a couple of days of losing that. So this is an improvement. We're coming back up just a little bit below 50 with the RSI, but the momentum in the shorter term is still negative for the small caps. And we've switched from negative to neutral with the small caps. We got just a little bit above the 50-day moving average with the mid caps, and they continue to be positive with the Elder's Impulse system. And we're looking better here with the Wilshire 5000. After getting below its 50-day moving average, it's now climbing above that. And the same thing with the total US stock ETF. Doing okay here with the financial sector, up a third of a percent, but still below its 50-day moving average. And now we're back to declining when we look at the ratio between the financial sector and the S&P. This is something that's been going on for a long time now. And just to kind of get some more confirmation here, I brought in this ARC FinTech Innovation ETF, another financial measurement tool, and it was up. It was up solid, but it's still below its 50-day moving average. Now, we did come down and drop below the 200-day moving average when we do a ratio of the ARC ETF, the financial ETF, with the S&P, and now we're bouncing up off of the 200-day moving average. So we're improving, but we haven't really overcome the weakness that this chart has been showing. The FANG index is still hanging out above its 50-day moving average. So Apple was up 0.45%, but not really breaking out to anything new, at least yet. We were up 1.83% with Amazon, but still kind of in a shorter term range. And we did bounce up with Microsoft, but we're still below the 50-day moving average. We are looking better here. Google was up over 4%. And so that's looking pretty good there. Meta still below its 200-day moving average, but it was still up on the day. Nvidia up 5.79%, but not back to an all-time high. This is looking better, and it's above its 50-day moving average. And then Tesla came down to its 50-day moving average. It was up 3.66%, but it's kind of been stuck in a range lately as well. And then Netflix did improve, but is still dealing with its 200-day moving average. And then we're keeping an eye on the semiconductors. This is what I picked out as support from last Friday. We came down to the 50-day moving average. We had dropped below it with all the main indexes that we follow. This one landed just about on the 50-day moving average, and then that's where we started to see the reversal on Friday. So on a daily basis, this is looking pretty good. This is where we found some support. We want the semiconductors to do well, and they did well on Monday, up 4.38% with this index. Now, this is the negative, or excuse me, the positive side. This is something to be aware of here. I pointed this out over the weekend. This is a weekly chart of the Dow Jones Semiconductor Index, and you notice that we're over the 100% level away from the 200-day moving average. My God, 100%. And you can see other times when we got about to this level, again, these bars are weekly bars here. This is about where we saw more of a meaningful decline when we get above this 100% level. And now we kind of been hanging out here without really any kind of significant pullback, at least to this point. We don't know if this is going to turn into something or not. We just want to be aware of this. I would rather be aware of this and not have it be anything than not be aware of it and say, oh, I wish I had known that. All right, then oil coming back up into the 60 range, and we are improving with the dollar. We're almost seeing a golden cross on the weekly chart for the dollar, where we still have a ways to go here on the daily chart. It's just the opposite of what you would think it would be. And we did come up just a little bit on a closing basis with the 4-year yield. And we came down a little bit here with the 10-year based on price. Did I say 4-year yield? I meant 10-year yield. Okay, and then okay here with the Qs to S&P, just trying to get back up to its moving average, still below the moving average with discretionary to the S&P coming back up to the moving average when we compare large cap growth to value. So we're a little bit above the moving average with the large caps, not looking really good with the mid caps and looking pretty good here, but not moving much with the index with the small cap growth to value ratio. And then here's the criteria for the Hindenburg Almond. We do have another spike. Now, this is from Friday now, so we'll have to see. Again, there's a 1-day lag with this. We're seeing a series of spikes here. And when we see this, we need to pay more attention to this. This is right before the COVID crash when we saw a series of spikes. Then we saw a series of spikes at the end of 2021. And then we saw singular spikes here kind of along the way. So those quickly fell off. And now we're seeing more spikes here. So we just want to be aware of this. So what's our outlook? The bond market will be closed in observance of Veterans Day on Tuesday. That might slow things down a little bit more. And then, okay, I didn't change this. We're positive on all three time frames. Sorry about that. It's Monday for me too. And now we're supposed to get the NFIB Small Business Optimism Index coming out on Tuesday. And then I say here the government shutdown should be ending, should being the operative word there. And then anything geopolitical, anything domestic that may have an impact, it's kind of about the government shutdown. That's kind of the catalyst for the feel good response that we saw with the futures on Sunday night going into Monday. And then we'll just have to see how all this plays out. Who knows what's going to happen here with the economic calendar, this calendar too. We don't really know. We're not very good for November 11th as far as seasonality, though. We just, the Dow, we're neutral to negative there. We are quite negative when it comes to the S&P and NASDAQ. Now, we'll have to see if this is the exception. If this always happened, this would be zero, not 28.6. That means 28.6% of the time we still go up. And we do see some a little bit of weakness here during post-election years with this chart, but then we come back into some more positive seasonality. But we just really haven't been sticking to seasonality lately. And November, again, positive seasonality. Another chart, positive seasonality till the end of the year. Also, Maybe we're finally coming out of this sideways range here after the Fed does a rate cut. And then we do tend to see more positive seasonality if we go back to 2008. This also shows positive seasonality going into the end of the year, as does this chart. And then this also shows positive seasonality for November. And then I'm probably going to take this chart down here pretty soon because we really pay attention to this when a lot of companies are on blackout because we can kind of use this as a pseudo chart for how many companies are reporting earnings. And we're kind of coming out on the other side now of the earnings reports. So we're still negative with the parabolic SAR and our momentum indicators. The ultimate oscillator, actually, it crossed back above 50. And then the bullish percent index, even though it improved, it's still negative. The vortex is still negative, and the momentum for the NASDAQ 100 is negative. Seeing another spike with the Hindenburg omen concerned there. I didn't show the mass index chart. We're kind of getting far away from that signal now, and it's becoming less and less relevant. And then on the positive side, we have our three smart money indicators here. And then the McClellan oscillator and summation index for both the S&P and Nasdaq, they're both looking more positive now. And now we're still positive with our growth to value and discretionary to staples ratios, but we're still looking more negative in the short term. And the swell trading oscillator, it kind of hung in there and was positive most of last week, even when we were having some problems. The ease of movement is just barely improving there. The money flow and the financial sector, and I showed those different charts, not only the financial sector, but the ARC FinTech ETF and how they've got a lot of damage to repair. If you watch the weekend videos, I show both the daily and weekly special K chart. Those are still positive. And here are the pivot points for Tuesday's session. So our conclusion, now we're back to positive on all three time frames because the 20 period moving averages have been reclaimed. We do have negative momentum, but it's improving. But now we're back to not trending, where we it looks like we were starting to trend. And we're still not trending in the intermediate term, but we're positive due to the moving averages. And we do see some improvements happening. And then with the long term, we're now back above that 10% level when we measure the distance from the 200-day simple moving average. Thank you. I hope you have a wonderful day on Tuesday, and I will talk to you in the next video.